Our next session will feature practitioners who work closely with climate-related private equity investments, tools, and frameworks. And to lead this conversation, I'm very excited to welcome Peter Ellsworth, who brings more than 20 years in capital markets, designing investment structures and risk management solutions. He is now a senior director at Ceres, where he works to strengthen sustainability policies and practices across their investor network. Welcome, Peter. I will hand it over to you to lead this conversation.
Thank you, Brad. Can you hear me in the back? Yes? Okay. Look, if anybody is hitting the wall after that delicious lunch, I see that there's a lot of sugar-laced soft drinks in the back, so we'll try to keep this thing going. Before I start, I thought I'd address something I hadn't intended to, which was that a few people came up over lunch and said, geez, how much money do you guys manage? Well, Ceres doesn't manage any money. We're an NGO based out of Boston. Most of you know us, some of you don't. Brad put a slide up there with sort of one of 8 lists of GPs they do business with. Well, I lead the private equity working group at Ceres, and an awful lot of those folks are in our private working group and more. Depending on the day, it's anywhere from 50 to 90 per session. LPs and GPs, which is what makes it very interesting. And because there's some folks from ICI here, ICI and Ceres also collaborate on another working group for North American GPs, and we do invite the LPs to that. So we've had a couple of really deep dives here on the NYU tool. And I don't know, maybe what we'll think of for this particular session is a little bit more like a buffet. And what we're trying to do is offer an overview of 4 resources to private equity investors that didn't exist a year ago, or at least 3 of them didn't exist a year ago. And importantly, all of them were either initiated by the investment community, the GPs, and the LPs, or they incorporated investor input. So I think that's a segue of sorts into why panels like this and days like this are important. You're going to hear from some of the leaders in this asset class on the panel, and we could have had many more of you up here. One thing I hope all of you take away is that private equity is doing an awful lot of hard work on ESG in general and on decarbonization in particular. 3 years ago, nobody ever would have anticipated that we'd have had these 4 resources that provide a practical roadmap, and that GPs and LPs would actually be buying into using them. So if you want to know how to get started and you haven't done it, or take the next step and credibly communicate the progress you're making, take a closer look at these tools and these frameworks. So here's a quick overview. The ESG Data Convergence Project was begun 2 years ago by a handful of GPs and LPs led by CalPERS and Carlyle. At launch, its members had $4 trillion in AUM. Today, more than 350 GPs and LPs are participating, with a combined AUM of 28 trillion and a portfolio universe of more than 4,300 companies. The participants report on metrics from 7 ESG categories. Then this past May, a private equity supplement was added to the Net Zero Investment Framework guidance. Some of you will recall that an earlier draft was released last year by IIGCC that the GPs and LPs didn't find particularly useful. It was too prescriptive in the wrong places and not prescriptive enough in others. It also didn't seem to understand some important aspects of how this asset class operates. So to solve this problem, a focus group of GPs and LPs was convened, including Keren, Steve, and Serge on today's panel. And after 4 months of discussions, moderated by the consultant and thesis, the participants agreed on an approach that worked for private equity. Continuing the buffet before we get to the panel, last month, a new guidance called the Private Markets Decarbonization Roadmap was published. It was developed by ICI, Bain Consulting, and the Sustainable Markets Initiative's Private Equity Task Force to provide GPs with a different but complementary framework for measuring the progress their portfolio companies are making to reduce emissions. One main difference is that it does not include expectations for target setting the way NZIF does. You'll hear more about this from Serge Younes. The last of the four we've really done a deep dive on, but you've all heard how NYU has been developing this tool to help GPs identify and assess key ESG factors during the due diligence process. And when used as part of this due diligence, it can help identify and prompt discussions about drivers of economic value. I don't think I need to say any more right now about that, though I will say that the panelist who was involved in the NYU program today is from the LP side, not the GP side. So there's a slightly different perspective. So with all that as background, I can introduce the panelists. Steve Hatfield is the head of ESG in the United States for Carlyle. Keren is Senior Responsible Investment Manager at APG Asset Management. Serge Younes is the head of sustainability at Investindustrial, one of Europe's leading mid-cap private equity firms. And Melanie Fornes is a climate change investment specialist at Glenmede Trust. To the questions, let me start with Steve. The ESG Data Convergence Project now has some 62,000 data points. This is the first time we've ever had good ESG data in this asset class. What have you learned, and what are these metrics designed to accomplish?
Yeah, thanks so much, Peter. If this is the buffet, I guess I'm your bread, so I don't want you to fill up, so I'll keep it short. But I don't know how long we can go with the buffet analogy, too. We'll see if we can keep it going. So 3, 4, 5 is how I think about the first insights from EDCI. So as Peter mentioned, 62,000 data points, 4,300 companies that are private equity backed. Pretty astonishing. We're super happy with that. The first year was 1,900. We hope that number to increase significantly in the future as well. But the 3, 4, 5. So some of the useful insights we found, first of all, renewable energy. Companies that are in portfolios for 2 years or more have on average 3 times more renewable energy at the end of their life versus when they entered the portfolio. The 4. So when we think about new hires, what we found was that there was on average 4 more net new hires per 100 employees created versus public equity counterparts. And then 5, in terms of diversity, equity, and inclusion, so for senior management positions at our companies, this is across the board, not just our companies, on average, 5% more women in those senior leadership management positions versus public equities. And so when you think about those insights, I know we all have playbooks. I know, a key piece of private equity is our active engagement of these assets. And so I think these are the insights we thought that would be there, and that's what we're starting to see in the analysis and the data. But how do I use that insight? I think some of us struggle with breadth versus depth in the portfolio. I know I do. We have a large number of assets. We're always thinking about where do we spend the best use of our time. This has given us a window, frankly, into understanding that performance on a comparable basis. It's decision useful information. We've also focused with the private equity companies on accuracy. Many of them in the past have been producing this data, but not to the rigor that was essentially financial audit grade data. So we feel very confident in this data. But what us enables to do is have a look across the landscape and quickly be able to triage where are companies performing above par, under par, where do we need to spend more time. Additionally, it's been a great common language for us with LPs. So I think in the past, we all struggled with the, commonly referred to in these sessions, the alphabet soup of acronyms. So glad that most of those are phasing away. So glad to see, at COP2 that TCFD now is formally disbanded. We're moving towards IFRS, and we have GRI, and then there's a little bit of ESRS on the side, but hopefully we'll continue the path to convergence. But that common language to assess how are we doing? We have these great methods, we have these great playbooks, we have these great strategies. How effective are they? And so to be able to talk with our investors about this is what we did and this is the results that we saw has been very powerful.
Let me try a quick follow-up. I mean, you did mention common language, but this started as a GP LP project conceived by Carlyle and CalPERS. How do you think that an LP, any LPs in this room, could make best use of EDCI?
The first thing, and can I see a show of hands? Who's part of EDCI? Curious. Oh, good. Okay, well, it's session over. Now, the first thing is, if you're not a part of it, join. I spoke with an investor of ours from Asia yesterday, and they were talking about how they were starting to work with some of their GPs on developing a common set of metrics. And I said, let me stop you right there. Have you heard of EDCI? And they said, no. And so, of course, I evangelized and said, well, you need to join right away. But seriously, if you're not part of it, join. One of the original reasons that we did it was, I know all of you are drowning in DDQs. We were too. And as we were talking about, one, having decision useful, comparable, critical mass of data that was ubiquitous across geographies, sectors, et cetera, this is that common language that we've got now to evaluate performance between GPs and LPs. So one, if you're not part of it, definitely join. The other part is that I really appreciate our LPs who push us on this, who look at the data, who say, okay, this is what we're seeing in this sector or this fund. Where do you expect to be a year from now? What are your concerns? What are the opportunities? I enjoy that challenge. I enjoy that push. And I would advise you to, if you're not part of EDCI, join. And then if you are part of it, use it as that language to engage your GPs. Use it to evaluate their progress. Use it to identify areas that they can improve in their strategy and their initiatives and their integration processes.
Let's do another poll. Who's not a member of EDCI? There's got to be somebody to raise their hands. Well, my response was going to be that's why we're doing this. Keren, you were part of this focus group last spring that developed the net zero investment framework component for private equity. That's a mouthful. And APG is a member of the Net Zero Asset Managers Initiative. NZAM is really a declaration that you intend to get to net zero, but it doesn't at all show how you plan to get there. Can you talk a bit about the purpose of this guidance and how you expect to use it?
Yeah, sure. I think and what we saw with the initial private equity guidance is that there's very unique aspects of our asset class that need to be addressed with guidance on when coming up with a net zero framework, the holding period, fund structure. And so this guidance really seeks to look at that and provide actionable guidance for private equity, whether you're an LP, a GP, a secondaries investor, a co-investor, buyout, growth. And what the guidance does is it provides really a blueprint for how to work towards net zero across a few dimensions. One is target setting. Two, particularly important for LPs, is engagement. What does engagement look like to demonstrate that you're working to get your managers that you entrust your capital with for purposes of achieving net zero to make sure that they're moving in the direction that you need them to move. And we're finding it quite helpful, both in terms of thinking about how are we going to assess GPs on net zero, how are we going to track GPs on net zero, and you know, we're really pleased to see that it's aligning with the other frameworks coming out, for example, from ICI, because we think it's also going to be useful, valuable, and important for GPs to use it as well.
And anybody in the panel that wants to jump in on any of these questions, please do. Don't stand on protocol or being polite. I'm curious, Melanie. Would you like to add anything to that Keren was talking about, or sort of using this as a using these frameworks as an engagement tool with managers?
Sure. I don't know if I can continue with the analogy, but I suppose I would be the very hungry customer. So to add to that, I would say and encourage absolutely convergence is what we're looking for, because rightly so, we have been immersed, drowning in an alphabet soup of frameworks, guidance, regulatory mandates, whether they're retracted, amended. So to see convergence is absolutely required for investors, LPs, to seriously step in and consider these new ways, essentially, of doing due diligence, and how can that be integrated into current due diligence processes is really what it comes down to, is how easily flexible, material, can it be integrated in how we are as investors already. So I'm very encouraged by the convergence we're seeing.
Can I just drill down a little bit more, because you were involved in the development and the beta test of the NYU tool. We have heard from other GPs up here. Could you speak to the purpose of this tool from your LP perspective, and how you've used it or plan to use it as part of your own due diligence?
Sure. I think for the LP toolkit, first, there is immense appreciation for the ability of this toolkit to condense and really filter down the sheer amount of data, frameworks, guidance into what really is, at the end of the day, an actionable Excel toolkit that investors who already use such processes already can easily integrate into their due diligence. Second, I would say it is not a black box whatsoever, and that's the beauty of the toolkit itself. It's very transparent, particularly each category being defined, suggested weighting, as well as underlying questions per each category. So the transparency is also a key value add, again, going back to this need of being easily integrated into investment and due diligence processes for LPs. So I'd say so far it's been great. Our team at Glenmede has integrated into our pre-existing, what we call an evaluation matrix. You can think of this as our internal SFDR, how we categorize GPs in terms of whether they are integrated, what we call mandated, thematic, their levels of impact integrated into their investment processes. So we've been able to easily integrate the LP toolkit into this pre-existing evaluation matrix and work, and definitely foresee it being able to drive monitoring in the future.
So, Serge, before I ask you about the Private Markets Decarbonization Roadmap, or PMDR, you were part of the group that worked with NYU on this tool. Do you have anything to add to Melanie's comments?
Some dessert, right? I hope you're all ready for indigestion now. Look, I think what was great about the work with NYU, and Tanzi and us have had a very long relationship now, spanning 7 years, is we kind of needed to take the work that was done with Rosie, that is very focused on return on sustainable investment, that was very focused on companies and what companies were able to achieve, and monetize that into something that a lot of GPs, a lot of investors could very easily use to kind of work through the hypothesis of what actually should work at each industry. It's closing the gap that SASB still kept open. And we heard from Tanzi earlier, SASB is still focused on risk. We kind of needed to take it to the next level. But ultimately, kind of my end goal, and it's the same goal that we had with the private market decarbonization roadmap and other things that some folks here in the room have heard of me over the past few years, is you do realize that there's about 50 or 60 GPs around the world that are really cutting edge. Let's say 200, just for the sake of being inclusive. There's a couple of thousand that are signatories of PRI but do absolutely nothing. There's about 4,000 or 5,000 that, frankly, have no sustainable or responsible investing program at all. So when you go back and try to understand what's happening with those 4,000 or 5,000, kind of the real reason is there's no capacity. They are 20, 30 people firms. They're maybe managing 100 million of AUM. They can't do what us larger firms are able to do. But ultimately, we all still have the same LPs. So the ones, Steve and I and others in the room who are privileged to be sitting in larger groups, who've made the investments to have big teams and have folks who are able to push, what can we bring to help those other firms who either are just starting or don't know how to start, right? And this is the kind of beauty of where that tool with NYU really sits, is how do we push it out to the 4,000 or 5,000 PE firms that we need.
In that spirit of what else can you bring, I think the group here is relatively familiar with EDCI. NZIF's been around for a while. thanks to Tanzi, we have a very full understanding of NYU and want to learn more of your tool. But Serge, I think the group would be really interested in hearing how, as you were involved in the development of PMDR, as was Keren and as was Steve, why is this an important addition to a GP's investment practice, and how do you hope that investors are going to use it?
So you're telling me, why do we need another thing? Why did we come out? Why did I spend a whole year to add another complication?
Why did you come out with it? And I just want you to know that you've got to limit your answer to 40 minutes.
All right. I think ultimately, look, the genesis of PMDR was the Sustainable Market Initiative. So the PE task force wanted to do something very specific that was tailored for private equity. If you recall, back in 2021, the ICI group and others, we worked with SBT to create a private equity framework. I think today we're about just under 20 PE firms that have validated targets, which is great considering a year ago we were 7. So that's gaining traction. And then, when NZIF version 1 came out, there was a lot of concern in terms of whether it will work. But again, if you look at it, there's less than 10 PE firms that are signatories of NZAM. So there was clearly a gap, and we're trying to understand what was happening. Why is there only 20 firms that have SBT? Why only 10 firms have kind of public net zero commitments? And it came back to something super interesting that we found out, through consultation with about 200 GPs and 50 LPs, which is there's actually a lot of firms doing a lot of good work that are really decarbonizing. And many of them actually don't want to make public commitments, excluding the anti-ESG sentiment. A lot of European firms don't want to make net zero commitments. And a lot of it comes because actually they don't understand what is net zero, right? I'm a climate scientist. I've spent 20 years doing that. I don't know what's net zero, frankly. If somebody can tell me, please educate me on that. So ultimately we said, well, what is the best mechanism that we can share with our LPs on the work that we're doing? I had a very funny conversation about a year ago with an LP, wasn't Keren. And they came to me and said, hey guys, you've been very transparent in publicly reporting your carbon emissions of your portfolio, and we've been doing that back since 2016. Can you explain to us why you've gone from like 1.2 million tons of scope 1 and 2 to about 3 million this year? What's going on? Did you guys lose your touch with what you're doing on your portfolio? As I realized, yes, but about a third of our portfolio changed. And I have chemical companies and I have industrials, and things do happen. And actually the ones that we exited were all completely decarbonized. Not completely, but if I look at our portfolio, everybody's decarbonized by more than 30% over the last kind of 3-4 years. So there was a different way that I needed to communicate. And NZIF eventually version 2 got to the same point where we're able to actually classify where our portfolios, where the individual companies sit on a kind of framework that goes with PMDR at not started, i.e. company has no idea what is carbon, all the way to where we get to with NZIF and SBT, where you're actually in net zero or you're aligned to net zero. So actually, if I turn back and I have a conversation with either Glenmede or APG, and I say, hey, 62% of my portfolio today is in alignment, and another 20-something% is aligning, and I've got 2 or 3 companies that we just bought in the last 6 months, they haven't started. That's a meaningful conversation that I can have, and this is where kind of PMDR came in. And PMDR, what it brought, sorry for another acronym, is the fact that the 3 of us here have pretty much worked on a lot of those frameworks, and many other people in the room here, is we've actually forced conversions in the market. So you'll see same nomenclature coming in NZIF and PMDR, same language eventually coming up in the SBT Net Zero framework for financial institutions, which is about a year away from being public. So the harmonization of that language is the same. Where is it different? And you mentioned that in the introduction, Peter, is PMDR doesn't require you to make commitments. It takes you from a starting point. You can still do all the work without making a public commitment. NZIF requires a commitment, and SBT will take you to having a third-party validation of that commitment where you are. What I can then see in the market is hopefully the large majority of the firms that don't have a climate program over the next 5, 10 plus years can start to adapt and use either of the 3. I don't care which one they use, as long as they start using it. And then ultimately what we're going to get is real economy decarbonization. I was in Dubai last week at COP, and I remember Finance Day. I got very frustrated from a conversation in the Blue Zone with some of the negotiators where they're saying, all what we need to focus on is kind of the largest emitters, and there's Scope 1 and 2 and all the Scope 3 stuff we need to deal with in the next decades. And I kind of drilled in the conversations, double click, and it's like, why? And what's the barriers? Well, the big publicly listed companies aren't able to push on their suppliers quick enough. And then I had a aha moment in the middle of the room. I was like, hold on. Private markets is mid-cap. We are Scope 3, right? But the conversation today goes from asset owners to publicly listed companies to their suppliers who are like, okay. What they forgot is speak to their shareholders. We will push it and make that Scope 3 change happen. So where all the three frameworks sit together on climate is helping that, what everybody's wondering, how are we going to tackle Scope 3? We will make it happen in the real economy.
I'm going to jump in. I guess in the cookies you don't expect at the end?
You go ahead, but please don't use the buffet analogy.
Well, I was the only one to not mention it, so I had to get it in one last time. I think, I just want to pick up on what Serge is saying, because it's actually really phenomenal. 2 years ago, there was really no useful guidance on net zero for private equity. And then you had IGCC looking at it. You had ICI looking at it. I'm sure you had others. And where we arrived at today are, four frameworks really that are all working together and aligned. We have a blueprint. We have a communication framework. EDCI really did a lot of work to make sure that the metrics that were chosen on net zero were aligned with all the frameworks out there. And I think that's really powerful, because now we as LPs don't really have to talk with GPs, oh, which framework are you using? This one, that one, which one we like, which we don't. We're all aligned, and we can really focus on what we're really going for, which is decarbonization and addressing climate change. And I think this is a really powerful blueprint that we've arrived at, or the model that we've developed and how we converge on net zero is a great model as we look at how to address other topics. For example, biodiversity is coming. So I get really excited seeing what we've accomplished and looking ahead to what we can do now that we've built that foundation.
Yeah, I have a couple of things to add here. So one is that when you think about these frameworks, to your point, they added something that wasn't there, but also when you think about how we design them to be very pragmatic in terms of how difficult decarbonization is. I really appreciated the collaboration and the dialogue in these working groups to address super difficult issues, frankly, that I think a lot of folks haven't really delved into. And possibly the understatement of the century is how difficult decarbonization is at scale. What we brought, a few of the conversations we had in depth was on, yes, it's optimal to set SBTs, but most of our companies that we've started to look at this goal with, they want to know, okay, I want to do that, and increasingly they have to due to regulations, customer expectations, but the C-suite wants to know inevitably, how much does it cost? We've pitched it as a moonshot, we'll figure that part out later. They don't like that. They want to know exactly how much it costs A to Z. Now to 2030, 2030 to 2040, and so forth. As we look at that, particularly in the carbon-intensive sectors, I know this sounds like a cop-out, but a lot of the technologies are not there at scale yet. We hope they will be. They're coming online more. We've had companies that wanted to purchase EVs in bulk and have had order after order after order canceled. And they're trying to commit, and they're now moving towards hybrids. They simply can't get the supply they need. And so my point on this is when we looked at creating frameworks that drove progress but were pragmatic, I think there's a nice blend in both of these, which is to say, while SBT should and continue to be the gold standard, there will be portions in the interim as we transition, as these fuels like green ammonia, hydrogen, et cetera, scale. It may not be as financially viable, particularly with our fiduciary duty obligations in the near term. And so to account for that in ways of saying aligned or not able to align at this point but still making progress is incredibly important.
I don't know how many years ago there was some bit of an offbeat movie about air traffic controllers. I don't remember if it was called Tin Cup or not, but the guy was asked, don't you worry about sort of taking a break? And, he said, it's a big sky. Well, you know what? It's a big GP universe. And I think one of the things that is really interesting about this panel and people here, many of you in the audience, is that there's kind of no ownership of one of these particular approaches. You know, it could be that, you know, one or maybe a combination of a couple works for one and not another, or an LP or not another. But we found at Ceres when NZIF came out that, you know, one of the big speed bumps was target setting. And there are plenty of folks that really do want to and are prepared to set targets. There are 4 different targets related to NZIF. But a lot of investors are saying, I'm not quite sure what this is all about. I'm not quite sure what it means if I set one. I'm really trying to figure out how I'm measuring, you know, real world progress. So I think that's one of the really important things. You know, we've heard about each of these resources, but you know, I'm thinking that maybe for a little while, maybe each of you can ask, how do these all fit together at your particular organization? I mean, let me start with Serge. I mean, we've got multiple approaches. How do you think about them at Investindustrial?
With difficulty. I think ultimately, look, we have SBT commitments. We are signatories of NZAM. We've made net zero commitments for 2035 as well. And we're actively working towards it. I think where it was complicated was that you're using multiple different frameworks and tools and trying to decipher outcomes and outputs from each of them. I think today we're in a slightly different world where it's not complete yet, but I think we've heavily simplified. Regulation in Europe doesn't help. We've got added complexity with SFDR and a variety of other acronym soups coming our way. But again, you know, with announcements that we heard last week with ISSB and some of the mergers that are happening in there, I think it looks positive. I think the tool from NYU is also extremely helpful because it brings quite a lot of those things together. I'd say keep an eye out to what's coming out from the UNPRI, what's coming out again from you guys from Ceres, some interesting stuff from Invest Europe. And I think what's going on is, as practitioners and in general, not just at Investindustrial, is we want one set of tools that we can work with that is kind of simple enough, and then let us innovate and do additional stuff when we have capacity to do that.
And I'll just say that it's more complicated for you because you've got the 2 hats. You're part LP and part GP.
Yes, but I would say here today I'm representing the LP side. So I'll speak to that in private equity. We're an LP in private equity. For us, and for those we invest in, climate requirements, net zero requirements are coming, and we're going to align them with the net zero, the IGCC net zero guidance. SBT is a valuable input for that. Provides Serge said, provides a mechanism for, you know, having your validated science-based targets. ICI is a really interesting framework. Very glad it aligned because, you know, I can see us looking for ways for GPs that report using the ICI PMDR framework to map that to the IGCC net zero framework that we're using. But that's the direction we're moving in, which is the IGCC one.
Melanie?
Yeah, I'll say 3 points here. One, and perhaps overlooked, but I think it's good to iterate, is that there is full buy-in in our private investment team. Led by the CIO, we see climate change as a very opportunistic investment set. And we see it both as a subsector as well as critically embedded in all other investments that we do. So just that buy-in seems a bit elementary, as we're all here already talking about climate and ESG investing, but I think that's a very critical step 0, we'll call it, that buy-in and that investor outlook and willingness to view the opportunity set as exciting. 2, then the step is integrating all of these frameworks into our investment processes, due diligence, and monitoring, which requires new expertise, new resourcing, staff. But again, as good investors, we're simply seeing this as expanding our aperture, making sure the breadth of issues, challenges, potential risks, and potential opportunities are being seen during due diligence and again throughout monitoring. And 3, something that's quite interesting is that we are investors throughout the cap stack. So investing in VC and these nascent technologies, it's yet another indicator or data point that there will be a better inflection point bridging these technologies to later stage investing if these later stages, growth equity, are already considering these through these frameworks. So generally we see encouragement that the full cap stack of climate change investing is ready, and perhaps climate change or climate tech 2.0 is a good next step away from clean tech 1.0, which I know a lot of investors maybe cringe at. Bad memories.
So, Steve, give us your take a little bit, but I'd also like to hear the extent to which some of these issues find their way from your team to the deal team.
Yeah, that's a great point. Lots to say in these. The first thing I want to go back to for a second is we talked about how these frameworks brought clarity to private equity, which hasn't historically been here. The other thing that we've run into, many of you probably have as well, preparing for some of the new obligations from California, CSRD, eventually whenever the SEC comes out with theirs. The guidance around greenhouse gas accounting is still being developed in a lot of ways, which is kind of mind-boggling given how long it's been out there. But the original greenhouse gas protocol was developed for corporates. And so obviously we came out with PCAF and there's ICI guidance and et cetera. But I was at a conference 2 weeks ago. It was really, really interesting. It was for ESG controllers, which is a newly forming position, and all talking about, audit grade data in response to these regulations. But we got into some really deep debates on guidance for, scope 3 of your scope 3. And in particular with private equity, I know that's still problematic of exactly how you go after that. The guidance is not consistent in terms of it's carbon intensive or across the board. Even if it is, you get into the area of data accuracy and PCAF quality scores. And so I guess my point on that to this group is we still need to work together and figure that out. And there was kind of a call to action even at that corporate group. It was Fortune 500 companies. I was at a table with, companies like Costco and Amazon and JP Morgan that all are trying to figure this out as well. So that's one part. The next part is on these frameworks, I want to echo that I know we've talked about there's too many and we need to converge. They each have different reasons that, EDCI is not another framework. It's designed to be a critical mass of decision useful information, ergo it's just gathering from existing frameworks. And so the EDCI group was heavily involved with the other two frameworks in terms of saying, we just want to pull from what you already have versus making something new. The other thing that I think that's useful about the frameworks is instigating progress with portfolio companies. I spend a ton of time with them on trying to help them figure out how do you decarbonize. We, of course, didn't want to invent anything new, so the backbone for this is TCFD, right? And so that's the great building block. That's also great when you think about these regulations coming out. So, a couple of years ago, and I was really excited when we started building the frameworks, I thought, okay, here's a great tool to help instigate progress. I would say that's almost completely flipped for me now, where I have companies calling me almost every day saying, please help, we just found out we're in scope for CSRD, or California, 253 or 261, or the UK's PPN 06-21, or they're getting ready for FAR from the US government whenever that comes out. So now we're saying, okay, here's actually a great framework that we want to report progress with, but also that can help you set up an effective decarbonization program. And I think most of you are familiar with these, but it is nuanced to private equity, right? So it contemplates majority versus minority stakes. It contemplates the ins and outs to your LP's earlier question of why are emissions higher if you're working towards decarbonizing. Your last point on the deal teams. I think it goes back to setting expectations. We're constantly having education, knowledge transfer sessions with our deal teams on here's how the world's changing. I remember when I told them about the California bill that was signed, there was kind of a shock and looked in the room for a while of, wow, this is serious and it's significant. And we said, yeah. And I think in the past, I always go back to 3 things for our companies of you have to build the business case for decarbonization, ESG in general. But the 3 things that help me all the time are regulations, operating excellence, so reducing cost, and we've talked about today the opportunities, so looking at end markets and how you can have low carbon products, particularly with mechanisms like CBAM coming out that are demanding lower carbon products. And then also LP expectations, right? And so they're at the end of the day, they're our customers. We want to make sure that we're collaborating. We have a dialogue. What are their expectations? We've heard about some of the goals being announced for net zero today. And so talking with the deal teams about this is the way that the world's headed. We live, breathe, and eat and sleep this every day. They do not. But then having those very black and white criteria has been super helpful for them to understand what we're moving towards. And I'll give maybe one very specific example. So Carlyle, as part of our net zero goals, our second goal is that starting in 2025, majority-owned companies will set Paris-aligned targets within 2 years of ownership. One thing we've really started to think about critically is how do we diligence investments on the decarbonization cost over the hold period. I think in the past, we have, of course, have looked at decarbonization as an aspect, as a thinking about what are the opportunities, the risk, but now going into that, we want to make sure that's baked into the run rate analysis so that the investment thesis doesn't see any surprises in terms of heavy CapEx and OpEx investments that you have to make along the way.
Thanks, Steve. Scope 3's come up a few times, and just for anybody who's not aware of it, ICI put out a fabulous piece on Scope 3 in the technology sector. Is it technology or software or both? But software. Yeah. But software. But yeah, it happens to be in that sector. But if you take a look at it, everything in there can, resonates with any other sector you're working with. And now there is another more comprehensive piece coming out in January. Exactly. Yeah, but that one's already out. I would suggest you taking a look at it. Look, let's just shift a little bit. I want to ask each of you how you think about balancing decarbonization and the all-important growth, and where the two might conflict. So I will start anywhere, but how about you, Keren?
I think we see a lot of opportunity to achieve growth through decarbonization, and we've seen great case studies and examples in our portfolio where costs are reduced, where values increased at exit. And we see that growing, particularly as the pressures from climate change increase, particularly as capital flows towards climate solutions. So we see long-term value and opportunity now as aligned with decarbonization on the growth side.
If you don't mind, let me take it next. I think, look, we interviewed the leadership of PESMIT, which is the SMI private equity task force, 10 of the biggest GPs around the world. And 60% of the CEOs said that they expect a 10 to 15% destruction of value if the companies don't decarbonize in their portfolio. Now, this is quite important because it just tells you that senior leadership in all the big GPs are now focused around it and understand that there's an issue. We have a dual problem in private equity, which is, we tend to do buy and build strategies, or we have very fast growth companies in our portfolio, especially in the mid-cap. And you have to try to figure out how do you actually decouple growth from carbon. It is feasible. I have one particular company that I'll use them in two examples today. It's a company that manufactures pumps, and it's the pumps that you find in pretty much every single coffee machine, either in a bar or at home. Very innocuous, but we wouldn't have our caffeine dose in the morning without that company. It's grown pretty much 4x in terms of revenue and size during our ownership. And over the first year, what we've seen is a doubling of its emissions. And then we decided at that point, okay, we're going to tackle carbon emissions very aggressively. They're renewables. We've set science-based targets, and we've been working to decarbonize. So today it's a 4x growth, and actually we've reduced the overall absolute emissions by half from our starting points. Where it became really interesting is their biggest customer is one of the big coffee producers, and they've released a tender about 6 months ago and said to all the suppliers, and there's 3 or 4 players in the market that can compete, and said, we will only give this tender to whoever is the company who has the science-based targets. And guess who had it? We did. Right? So that's 80 million machines over the next 5 years that will come from our portfolio company. Can you imagine the destruction of value if we hadn't done NSBT? That is pretty much half of the revenue of the business gone.
You stole my point.
Oh,
No, I'm just kidding. No, I completely agree with you. Just to echo off of that, I would say that it's not decarbonization versus growth. It's decarbonization is growth. And that, I think when you look in the past, I think we've all been waiting for this moment where, we talk about ESG value at stake. You can measure it. There's opportunities. I think they've been sporadic, and I think they've been growing slowly. I see an inflection point from these regulations. You have 40,000 plus companies because of CSRD starting to do that reporting. You have, I think it's 7,000 plus that are affected by California, maybe 3,000 plus around. This is a paper from PwC. So PwC people, if there's anybody in the room, we could look at this piece, but I think it's 3,000 that are newly impacted by the SEC. When you look at that, we always talk about, at least at Carlyle, this carbon domino effect happening through the value chains. We're all connected through scope 3, right? And as you fast forward, because of these regulations, obviously it doesn't stop at measurement. People are going to do something with these numbers. You're going to be evaluated on that. And to Serge's point, we also had a company that was in a tender, and I think it was 5 of their largest customers in their tenders that said you have to have an SBT by June of next year, or you will be an ineligible bidder, full stop. We have another company that's in scope for the UK's policy procurement note, and I believe it's by 28 or 29, they have to have an LCA for all their products. That's significant. And where that's headed to, right, is CBAM, the Carbon Border Adjustment Mechanism, where they're going to be evaluated on the carbon footprint of their products. So this is all spinning up, and I think it's going to accelerate now from these regulations. Particularly, California, it throws me for a loop that scope 3, it's mandatory to report all 15 categories. That's massive. That's a huge implication. They're the first one to do that, not just the material categories.
A lot of money for consultants. For
It is, I know. Yeah. There's a lot of assumptions on assumptions. So I do believe we're increasingly headed towards this world where you cannot be successful and grow if you aren't decarbonizing.
Just doubling down, I would encourage these sound bites even are tremendous when talking to investors. But good investors will already know this. They already know that today it is a risk if you're not considering climate change operationally or through milestones in investment, as well as the upside as well. So for those that perhaps don't see the full opportunity set, these stories really go a long way for investors.
Well, let's just talk for a second about different investors on different paths. Like, not every investor, not every GP, to be more specific, is on the same reduction path as you are. Do you think it's realistic for LPs to start asking their GPs to use the PMDR and report what they're finding? Is that a reasonable ask?
It's a question for me, I guess.
It's actually could be for everybody, including the LPs. Would you? I'll let you start, Serge, but I'd be very interested in finding out whether the LPs here would make that ask.
I think, first of all, it literally takes 10 minutes to fill in the PMDR. It's a qualitative yes/no. There's a series of points. It's integrated in EDCI. So next year, you've got all the 350 members, signatures of EDCI will be submitting on their portfolio companies, each company where they are. It will spew it out. A tool is coming to what Keren was saying earlier, that they need NZIF, other LPs have requested PMDR. A tool is being created that you'll put the same input and it will get it out in the 2 different formats so you can report it to LPs. I think what is happening, and I'm sure Keren and others will talk about, is this year we're seeing more and more LPs demanding GPs to set commitments of some sort. It's definitely coming from some of the big European LPs, some of the US LPs is coming through. I've heard it from Middle Eastern and Asian LPs in the last couple of weeks, which is something that I wasn't expecting even a year ago if you asked me that question. So the challenge is on us now to respond. I think what is missing is what we had done with ICI and Ceres and IOGCC over the past few years, which is not just educate the private market community, but also our advisors who are working with us. A great example is the GHG guidance that we produced a year and a half or 2 years ago now with ICI, which a lot of us were getting conflicting advice from consultants who might understand carbon really well, but as you said, Steve, they don't understand private markets. They don't understand what is our scope 3 and our scope 1 and our scope 2 and all that. And what we need now is the next iteration of advisors. I got a grilling the other day by by an LP, a European LP, saying, you guys are doing all this net zero and amazing stuff. Why, Serge, aren't you accepting net zero language in the LPA and side letters? I was like, well, both sets of lawyers aren't educated in it yet, right? So we need to give it time. We just need to get more and more people familiar with it. And I'm not going to start talking about Scope 4 and many other things that we need to resolve still. There's still a lot happening.
I would add that these guidances are just a very easy way to touch on all the critical components that should already be asked by LPs to GPs. I think maybe a differentiation might be, what type of GP are you talking to? Are you talking with a Carlyle who really good at navigating all sorts of DDQs and RFPs, or perhaps you're working with the emerging manager small VC fund. So that's going to be a little bit more high touch, a more collaborative process. But regardless, these types of guidances, frameworks, really are nice insofar as they cover the basics of what already should be integrated in due diligence processes.
So before APG, I was actually on the GP side. And I remember when I was on the GP side and it came to submit information to LPs, I always felt this pressure to have the perfect answer, that we had to have everything achieved and perfectly successful in order to give it to LPs. And now on the LP side, I see that what's really important, what we're really looking for is transparency. Because this is, especially on net zero, this is about a dialogue and understanding where GPs are moving and how we're approaching net zero. And that's not going to be solved tomorrow. That's not going to be solved next week. So even if, the disclosure's not fully there yet, we do want to see what we can so we can have that conversation and monitor progress over time, because this is really a long-term journey for all of us.
We're going to open this for a couple of questions in a minute, but I have one for Melanie and one for Keren. I mean, you've got a couple of GPs on the stage here. Anything you want to publicly ask them?
I have one. So I like to think of it all as a Venn diagram, whereas on one side is where we're seeing all of the regulation, the mandated questionnaires and due diligence procedures happening, and on the other we can think of that as just best practices and true value add to portfolio companies. So I would just like to ask, where is the overlap, or more importantly, where is there no overlap? Because as investors, what we really want to see is not this to be a check the box exercise, but truly you are changing your ways of adding value, changing with the tectonic shifts we're seeing already in capital markets in our economies. I really want to see that integrated in investment processes and portfolio management. So Venn diagram, over where's the overlap and where does it tend not to overlap is what I'd ask.
I love that you just said that.
You're not being recorded.
No, I do. I think it's a fantastic. I was just thinking, because when we think about decarbonization, and to go back to these frameworks, the one thing is you think about how they were set up and to instigate progress and to track progress. I think there may be the notion that the idea is to get everybody fully aligned by the end of that. And that's not necessarily the case. And as you go back to why, you have to think about what I said in the beginning about how pragmatic is it to decarbonize and the underlying investment thesis. And as we think about that, I always think about a 2x2 matrix on two lines of, one is asset heavy versus asset light companies, and companies that are impacted by regulations and companies that are not. And you could add to regulations also commercial excellence and customers, because I think what happens is you have the companies in the upper right quadrant where it's just a no-brainer. They're asset heavy, they're in scope for regulations, their customers are asking for it. But you juxtapose that with the other quadrant where you might have a services company with 30 people that leases 2 offices, and do we really want to spend our limited resources and time having them set SBTs where essentially it's going to end up them buying recs? This is basically it, and spending a lot of money on consultants to track a huge long chain of scope 3, which probably is 99% of their emissions. I wouldn't say that's first in our priority stack for decarbonization. I don't think they're going to, and we talk to them, we say, this is what SBT is, this is how you can set it, and they're like, well, great, tell me the business case. And there's not really a great business case unless we just want to create an exhaustive approach from A to Z. So I couldn't agree more on that. We do want to focus on that nexus. The good news is, I would say increasingly, again, I've said it a number of times, but regulations are such a significant tailwind right now that I think things 5 years ago we had to convince companies to do, they're now like, yeah, absolutely, let's do this, or even customer pressure. We've moved from the why to the how, which is great.
You have anything before we open it up for questions?
I'm happy to give my time to the audience.
Anybody have any questions? Can, is there a mic that we can bring over so everybody?
It's mic'd all around.
Oh, it is? Okay.
Question for Steve. So, Carlyle owns a company called NGP, is majority owner of a company called NGP, which is an oil and gas exploration and production company or investment manager. It is Carlyle counts it as part of its assets under management. It accounted for something like half of Carlyle's net income at the corporate level last year. But Carlyle excludes it from its emissions reporting, right? PCFD reporting, whatever. So I guess the question is, like, to what degree is Carlyle's net zero plan contingent on sort of selectively excluding its dirtiest assets, like NGP? Or will you report NGP's emissions?
Well, today we don't report any of our portfolio emissions, to be clear. We are preparing to do that. And so it hasn't been selectively excluded, but it hasn't been reported. So we've aligned with PCAF. We're measuring all of our emissions. We have a net zero goal. We're focused broadly on engaging, not divesting. If you divest from any carbon intensive asset, you're not changing a single molecule of carbon in the atmosphere. And that, when we talked about these net zero frameworks, is so critical, is the engagement aspect. And so in our investments, we are focused on that engagement and focused on working with management teams to figure out what are the right transition plans. Essentially, as this economy moves forward and we increasingly see regulations bite, customers bite, we want to prepare them for that transition.
Can I just add to what Steve just said? So, is it Jim? Divesting is the wrong thing because you need to kind of go back and think, where's it going to go, right? So, we all work for the same masters, right? I'm going to simplify it for everybody. The asset owners will see this company again and again and again and again. I had an LP from a religious group who grilled me a few weeks ago on an oil and gas company and said, where's this company going to be in 100 years? Like, I'll be 6 feet under. I have no idea where that company is going to be in 100 years. So remember that if they don't do anything, it's going to end up with somebody else who's not going to do anything. And you know who's stuck with it? Those two for the next 100 years. So somebody has to start the work. And they're starting the work. We're doing our bit to start the work. Other GPs in this room are doing the work because ultimately it's going to end up either with another GP or it's going to be IPO'd or it's going to be somewhere else with an industrial who still have the same shareholders. Ultimately, we need to do the transition. And as PE people, we're smart at creating alpha and generating opportunities. And today, the biggest opportunity is in this transition space. You're buying something at very reduced multiples today. You're going to spend CapEx on it for the next few years. There's a lot of impact investors that are desperate to really high quality assets who will pay premium multiples for it. We're not dumb in this industry. We like to make money, and we like to make money for our LPs, and we're looking at those opportunities to do that.
So having nothing to do with divestment, but having everything to do with the natural life cycle of ownership, anybody who's not aware of it, Ceres has developed some principles for responsible asset transfer. Might be worth looking on our website for that. We're trying to get industry buy-in for that. And before I ask for the last question, if anybody wants a little bit better overview of PMDR, I know that Serge and ICI are doing theirs, but Ceres is going to be doing one on January 9th. And if anybody is interested in understanding a little bit more of what PMDR is like, get in contact with me. So one more question. You're up.
Thanks. Question for the LPs and the GPs. Question for the LPs and the GPs. I think ESG carry fees, been tossed around as a concept for the last couple of years. Just want to get your thoughts and your perspective on, is it applicable? Is it the next stage of forward, sort of, hastening decarbonization as an incentive? So, I'd love to get your thoughts on that.
Yeah, it's a great question. So we're looking at moving capital into impact, and as part of that, we're looking at impact link carry, which is a really important requirement for us. It's complicated and it's early stage, but we do see it as an important practice to develop to ensure that incentives are aligned, not just on the financial side, but also on the impact side, since one of the reasons we'd invest is for our impact objective. I think once we have models on impact link carry, it'll be interesting to think about it from an ESG link carry perspective. Right now, the best practice that we're looking for is ESG meaningfully integrated into compensation, not as a checkbox, but as a real accountability mechanism for deal teams to drive on these ESG initiatives, notably net zero.
I'll mirror what Keren said, right? ESG linked carry is something that some firms are starting to toy with. It's underdeveloped because you need to get to what Tanzi was saying earlier. It's not outputs, it's outcomes. And you need to get the mentality in terms of every single investment. What is the outcome that you're looking for? And how then do you link that to carry vehicle? Remember, you're negotiating carry and outcomes before you even start investing, right? So there's a little bit of strategic thinking, which is slightly easier with impact funds who may have a specific mandate, but it's a space to look out for, right?
Yeah.
Exciting.
But even it's really exciting, and the data is going to be key. And with EDCI, we're really at the beginning stages of having that data to really drive this conversation. So yeah.
I have to add as well, it's very nascent to look at new carry structures, even decarbonization hurdles, which is very new as well. I would emphasize team matters. Private equity due diligence has always had a heavy emphasis, particularly in the early stages of team. Now is the time to start looking for diverse team and talent. We need new talent in this space to more robustly evaluate these investments. So that would be last. Yes. That was planned.
So,
Here.
so, Tanti, it was very nice of you that we went over by about 37 seconds, and some fire alarm didn't go off when the clock hit 0.
10 minutes. 10 minutes.
No, okay. Anyway, we're done.
All right. Thank you so much.